Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering some proposed regulations that would limit the relief for large gifts made prior to the estate tax exclusion dropping back to $5 million in 2026. We have a longer discussion of this in the June issue of Spidell's Federal Tax Letter. You can get subscription information on this monthly publication at caltax.com under the Publications tab. The IRS issued proposed regulations that provide an exception to the gift and estate tax basic exclusion amount special anti-clawback rule. Unfortunately, the regulations apply limitations that were not originally anticipated. This could create significant estate tax liabilities for some advanced gifting strategies. The Tax Cuts and Jobs Act doubled the estate and gift tax basic exclusion amount from $5 million to $10 million adjusted for inflation for the 2018 through 2025 tax years. The exclusion amount is $11.7 million for 2021 and $12.06 million for 2022. But it's scheduled to decrease back to the $5 million inflation adjusted amount in 2026, and there's been a lot of discussion about a potential decrease before that date. A big concern taxpayers had when the exclusion amount was doubled was, what happens if a taxpayer passes away after 2025 when the decreased estate tax exclusion amount of $5 million is in effect, but they had made excludable lifetime gifts greater than $5 million under the increased basic exclusion amounts that were in effect for 2018 through 2025. The question was whether the amount of gifts in excess of $5 million would be subject to the 40% estate tax rate. The IRS addressed this concern in 2019 when it adopted final regulations providing a special anti-clawback rule for taxpayers who made gifts in excess of $5 million prior to 2026, but who pass away after 2025 when the $5 million exclusion limit applies. These regulations allow taxpayers to exclude the higher of the amount of excludable gifts given when the higher exclusion amounts were in effect, or the basic exclusion amount in effect during the year of the decedent's death. So if a taxpayer makes $9 million in gifts in 2022 when the $12.06 million basic exclusion amount is in effect, and the taxpayer passes away in 2026, the exclusion amount applied on their estate tax return will equal $9 million. It was clear the anti-clawback rule applies to completed gifts made during the donor's lifetime, but the IRS stated at the time the final regulations were adopted that it would provide additional guidance to address situations where a donor makes a gift during their lifetime, but still retains significant beneficial use, enjoyment, or control of the transferred property. In the new proposed regulations, the IRS is taking the position that the anti-clawback rules will not apply in these situations. Instead, the basic exclusion amount in effect on the decedent's date of death will apply to such gifts. If the death is after 2025, the $5 million inflation-adjusted exclusion amount will apply. The exception to the anti-clawback rule applies even if effected transfers are actually completed within 18 months of the donor's date of death, meaning that the decedent no longer had the use, enjoyment, or control of the property during the last 18 months of his or her life. In this case, the basic exclusion amount in effect on the decedent's date of death will apply. But there are exceptions to the exception. The anti-clawback rules will still apply to gifts that are not material, meaning that the taxable amount is 5% or less of the total amount of the transfer valued as of the date of the transfer, and transfers, relinquishments, or eliminations made within the last 18 months of the decedent's life if the transfer, relinquishment, or elimination occurred as a result of the termination of a durational period described in the original transfer by either the mere passage of time or the death of any person. So, for example, the complete transfer will occur at the end of a 5-year period or the death of the decedent's spouse. There's been some political pushback to these proposed regulations, so it's uncertain if they'll become final in their current state. If they do, clients with complex gifting strategies may be facing much larger estate tax liabilities than expected. For some estates, we could see scenarios where there aren't sufficient assets left in the estate to satisfy the estate tax liabilities. You can get quarterly updates to keep your clients current, as well as new tax planning strategies to minimize taxes with Spidell's quarterly federal tax update webinar series. Register for a full year or just one session at caltax.com under the webinars tab. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.